All right, we're going to jump into intangible assets here. Much like PP&E, the book provides a lot of examples of, different costs that might be included. I think it's a little bit more complicated with an intangible asset, kind of as a highlight here, is because usually there's not there's no physical substance, so you're usually buying a right, and a right is going to have a little more uncertainty than a building or something like that, where just the outcomes become a little more uncertain. The other issue is that with intangible assets, you can develop them internally or you can purchase them, and so the way you account for things is a little bit different depending on which the way that you obtain that intangible asset. Purchased intangible assets, much like PP&E. Now, I will say intangible assets a lot of times will have more legal fees and other costs that PP&E typically doesn't have, like transfer patents and things like that. There's a little more legal process involved. The other thing is that there are sort of some uncertain things, especially with things like goodwill, where this idea of goodwill is misunderstood. So a lot of people think, oh, well, goodwill, that's my brand reputation, that's the strength of my management team, or all these things, and that can be internally developed, or it can be purchased. So you could purchase another company and purchase them for their brand name, for the strength of the management team, whatever it might be. Because of that, we really do need to walk through how we account for goodwill. It's a transaction a lot of companies will record. Anytime and we'll get into the details, but basically anytime there's a buy or a sale of all or part of a company, a lot of times goodwill is going to arise from that transaction. But internally develops a little bit different. So if you're internally developing intangible assets, pretty much they're just going to be expensed as research and development costs. And the reason why is because it's very unclear what the future benefits of those things might be. Because that is a challenge, essentially we just expense it. Again, other than maybe, like I said, there might be some things where you file a patent or something like that, but the cost of developing that patent would not be capitalized. And again, if you remember, we're always choosing somewhat between, are we going to capitalize this cost, which means we create an asset and then we depreciate, deplete, or amortize it after that, or are we going to expense it immediately? All right, so patents. Again, when the cost to obtain a patent, which again, if it's external, it might include the purchase price. But if it's internal, it's really going to be just those legal expenses. Now, after you initially record the patent, you may have to defend the patent. Those costs get added to the patent. So rather than expensing legal costs, you just add it to the patent. Copyrights, very much like patents, except for with a patent, you have 20 years of the exclusive right, whereas copyright is 70 years. And I believe it's 70 years after the creator's passing. And so it can be quite a length of time. So, like a lot of music that we listen to, if it's classical music, obviously the writer has been gone a long time, so you can use it however you want. But if you wanted to use like Michael Jackson's music, even though he's passed away several years ago, you can't use it even if he created that music more than 70 years ago. Trademarks, they're a little bit different in that you can renew a trademark. So it's like 10-year increments, but you can renew it. And so they do have an indefinite life. And so for trademarks, you don't typically amortize those because of the indefinite life of the trademark. Franchises, again, that's a legal right to use, things, whether it be name, likeness, trademark systems, or other things that a franchisor might provide. That cost of obtaining that franchise or obtaining that right, that's going to go on your balance sheet, and you're going to amortize that typically over the life of the franchise agreement. Obviously, if it's an indefinite agreement, then it can get a little bit different. And also, it does a little bit depend on what the franchisor is obligated to provide post-sale. Really, there's a lot of nuance in that, and we're not going to go into that detail, but just understand that's kind of a whole separate item. If you remember that from RevRec, from the revenue recognition material, we kind of talked about that too, that there's different types of franchises or intellectual property. Goodwill is the one we're going to spend a lot of time on. And so it's an asset, it's on the balance sheet. And the key here is it represents consideration given to acquire another company above the fair value of the acquired company's identifiable assets. And so there's a lot of nuance here, but the only way that goodwill arises is if there is a transaction. In other words, you must purchase the identifiable assets of another company, and any amount you pay over that fair value, we throw into this goodwill account. So you cannot internally develop goodwill. It's only through an external transaction. And I will say this, the way that you account for goodwill and those identifiable assets, it does have a lot of implications, not only for financial accounting, but also for tax purposes. And so a lot of times in a transaction, for tax purposes, the seller typically wants a lot of things counted as goodwill because you get taxed at like 20%. But if you assign a value to like property, plant, equipment, and the fair value is above the book value, you get taxed as ordinary income on that difference if it's an asset sale. So there can be, and that's like 40%. So you could end up paying twice the tax depending on how it's being treated. All right, here's an example. So Fortner Company, they buy all the outstanding stock of a strategic partner, $16 million, dollars, and they also assume some debt. And so they have these identifiable assets. So again, there's a process that the company would go to value these assets. Typically receivables, pretty straightforward. It's pretty much going to be dollar for dollar. Inventory is usually at cost. And I'd say like the cost of replacement. If you remember, we just did lower of cost or market. You do that kind of a process to value the inventory. Private plant equipment, that's one where there could be a lot of argument. I might have comparables, but it's not going to be exactly the same thing. So, this is a little more, you might rely on a third party to provide to do like a market assessment. A lot of times, like especially if it's a heavy equipment and things like that, they're going to look at mileage. They're going to take pictures to see what kind of shape it's in, and then they might go back to like the original manufacturer or a dealer and say, hey, what's the fair market value of this asset? And so this is where a lot of things can get negotiated. I'll just say that right now, because the fair value that you assign to property, plant, and equipment is a point of negotiation because of the tax implication. And then finally, the patent, obviously that's going to be very squishy. It's going to be very difficult to value a patent. And so again, you might rely on third parties or it might be a negotiated outcome. But essentially, these first two, pretty straightforward in valuing those. These last two, much less straightforward. All right, so how do we calculate goodwill? So it's the purchase price, and this is the net assets acquired. And so we are acquiring these assets, but we're also assuming a liability. And so when we talk about the net assets acquired, when you acquire a company, you get their assets, but in this case, they're also getting their debt. Sometimes you might do a debt-free transaction, but in this case, they're assuming the debt as well. And so really, the goodwill is the difference between the purchase price and the net assets acquired, which would be your assets minus any liabilities that you are assuming. All right. So again, purchase price minus net assets acquired. So the purchase price is $16 million. Dollars. The fair value of the assets is $14,100,000. And of course, we're assuming $2 million of debt. So that gets us our net asset number of $12,100,000. And so that difference then is what we would assign to goodwill, $3,900,000. So then the journal entry, hopefully by this time, the journal entry is pretty straightforward. Of course, you're paying cash, you're going to credit cash, you're assuming some debt, so that's going to be a debit, and I just sort of lumped everything together. We know in reality this is probably several distinct items, but I just made it easy. And then, of course, then we got the fair value of all the assets. We're going to bring those on our books, and then goodwill ends up being the plug. And again, with these different assets, I tried to roughly put them in order of liquidity to make it, kind of make sense. I don't, these aren't like specific numbers that have to be assigned, but these are a number, this numbering system would actually probably be pretty close to what a company would use. Next subject, we'll move through lump sum purchases. I think we have enough time to cover this one here. So, a lot of times you might acquire assets in a bundle. So, as an example, if I buy a building, usually that building includes more than just the physical building. Obviously, you're going to be acquiring the land, the building itself, equipment, and other things, maybe like office equipment. And so, in that situation, you use what's called the proportionate fair value. You could potentially use other things like the residual value. In other words, if you can't estimate the fair value of everything, or maybe one item is unreliable, then you might sort of use this residual approach. But we're going to assume that we can estimate everything in our example. And so we're going to use the proportionate fair value. All right, so they purchased a facility for $4,500,000. Included some land, a manufacturing building, an office building, and some equipment. And so these fair values would have to be given to you. Obviously, in practice, an accounting firm would go out there and, much like we just talked about, they'd go out and estimate these fair values. But what we can see is there's a mismatch between the total fair value of the four items, 5,150,000, and the price that I paid. And really, the only thing we can conclude from that is these are not like a direct reflection of the way the transaction was consummated. And so, while the land itself might be 1.4 million, when you put it in the larger, sort of portfolio, basically that bundle means you're going to pay an amount that's different than just the simple sum of the fair values. And so we're going to use that proportional method to say, figure out, okay, given these fair values, really the issue is I'm allocating this amount for the price. And so I'm allocating $4.5 million. And so, I'm going to assume a cash purchase. That's the credit. Well, all of these items are going to be debits. And so if I just added these up, I would have more debits than credits. Now, obviously, I might choose to say, oh, let's record, some sort of gain or something like that. And I suppose that would be one potential approach, but under US GAAP, instead, what we do is we just proportionately allocate. And so the way we do that transaction is, again, we're just trying to figure out what proportion of this total should be assigned to the land, the building, the office building, and the equipment. And so for the land, of course, the fair value of the land is 1.4 million. It's proportion of the total fair value. So we divide that by 5.15 million. Of course, we're allocating the 4.5 million. And so that means we would allocate $1,223,301 to the land. Similarly, with the manufacturing building, its fair value relative to the total, and we're allocating the cash. And the same thing with the office building, and the same thing with the equipment. All right. So again, we're taking its proportion of the total fair value, we're multiplying it by the cash or whatever we paid to purchase the bundle, and that gives us how much of that cash we allocate to each item. And so we bring this information into our journal entry. And of course, there's the cash, that's the credit. And then each of those items represents an individual debit. And again, hopefully that wasn't too bad. We're going to start with non-cash transactions in the next video, and we'll just kind of keep going from there.